What's up, guys? Thanks for stopping by. This is episode 3 of the Strong Family Money Show Business 101. Video series I started to share what I feel are financial terms and concepts that everyone should understand. So in this episode, we're going to go over what a bull market is. Basically, a bull market is a long period of time where wealth, and this can be for stocks, bonds, real estate. So the value of something that we'll talk about it in terms of investing, right, goes up over a long period of time. It's characterized by consumer confidence, by strong results from corporations, and a lot of optimism from people who are spending money. So you can identify it in how consumers spend their money and how investors spend their money, and the results ultimately come out into how large companies do, right? It's characterized by so the trigger, or how you identify it. So there's a drop of about, at some point in time, a drop, and they characterize it 20% seems to be the magic number, and then followed by another rise of about 20% also. So it's like goes down and then it goes up, right? And then when you see that, and however long that lasts, right, that is the bull market. So investors during this time, they buy more stocks, right? Life is good, right? Something caused it to drop, but something then triggered a rise, and it really is lead lag, right? No one can really, both, right? The chicken and egg, right? Did people spending more money cause the trigger, or were there more things for the people to spend their money on that was at the trigger, right? So something will cause it. Companies bet more on their future at that time, so people are buying more. So they're going to say, well, we're going to invest more and we're going to make new things. So that also keeps the ball rolling. Because they're doing that also, then unemployment rates go down. So more people have money to spend, right? Money is easier to spend because everyone has more of it. So it's just a big churning of things that keep, like a big snowball that keeps running down the hill. It just keeps going, right? So more, and it's perpetual, right? So that there's more people spending money than companies that invest more on their company. And then when they do that, they need more people, so the unemployment rate keeps going down. So then the more people have money, so you see this is a big cycle that happens. So it's difficult to predict, right? So you can't predict that it's going to happen, right? You can only notice that you're in one. So people can't say, on this date we're going to start a bull market. And it's something that just gets triggered by something, consumer confidence, or a big company goes public, or a sector is doing well, and then that's a trigger, right? And it doesn't necessarily have to stay with that same trigger. It just, because the snowball starts rolling, it just goes on for a long time. So you can take advantage of bull markets by, once it's identified, you want to get in as early as you can, either by investing in stocks, like buy and hold, that philosophy. So you identify the stocks that you're doing well, or what the sector is doing well, and then you want to buy them and you want to hold them, so that over that time of where the value of the stock increases, you've held it because you bought it at a lower price, it then raises in value. Or if you're already doing that, you want to just like value investing, you want to just keep dumping money into the stock market, because nobody can lose, right? You want to be careful with that. So you want to maybe you might try, if you're able to do so, if you're able to learn it, if you are comfortable with it, try some sort of swing trading, day trading. So a lot of these things have risk, right? So all these things that we're doing to take so you're really taking advantage of a situation. And the bad thing about taking advantage of a situation is the situation can then stop, or the situation can then change dramatically. So, case in point is the tech boom, right? .com boom back in the 2000s. Nobody could lose in the stock market, right? There were people that probably had no business investing in the stock market, and you would just buy something. You get a tip from somewhere, and tip sites or people were big back then. You get a tip from somewhere, you dump your money in, and you're rich because for whatever, the internet. Well, the internet is the future, but at that point it was like, nobody, they were still expecting flying cars in 2020, right, at that time. So there was like, there's no stop to it, right? The internet is making it possible, right, for people to make money by having all these businesses start up and are online. And then it's also possible for you to then go online and do all this trading, right? That was also the start of, personal investing online, right? You can open an account at whatever investing site you want, and you were in charge of, taking care of your money, right? It was all basically luck. Everything started at the same time. It was just people dumping money into the market, and that just started this ball rolling, and people thought, this is never going to end, but we all know how that turned out. So, recent bull markets, post World War II, I think it's June 1949 to August 1956, the S&P rose 267% in that time. The housing boom, 2002, 2007, dramatic growth in the housing sector. We all know how that turned out. So anyways, there's always a drop, right? And the longest in history, March 2009 to March 2020. So we just had the end of a bull run here. And it could be turning around, and depending on how you extrapolate it or what time frame you are looking at, if we can recover. Anyway, S&P rose 400% from a low of 666 in March 2009. So bull markets are good to make money in. You must understand that they do not last forever, and you have to be cautious of how you use them to make money because they don't last forever. And as we found out, they can end at any time. Anything can cause them to stop. And then they don't really stop and level off. They stop and then they start falling in the other direction. So you have to, so the perfect scenario is you identify bull market early, right? And you can't, and just because you can't, just as you cannot identify a bull market before it starts, you can only identify it when it's happening, right? In my next video I'll talk about the other side of the equation, but you won't be able to see the drop off. You won't be able to predict it. You'll just see it start, and so at that point you have to decide what to do. It could be a dip, right? Or it could be, running down in the other direction. So you have to be able to act at both ends of that equation quickly so that you're able to make money and you're able to save money that you invested. So anyway, that's today's episode of the Strong Family Money Show Business School. If you have any questions, shoot me an email. If there are any financial tips or concepts that you want help understanding, let me know and I'll be happy to make a video about them. This is Andres, and I'll talk to you guys next time.